I'm very pleased to be given the opportunity of welcoming you here today, because I think that the results Nikki's going to talk to are pretty good. They're solid results in what has been a very difficult year for us all. And I think that all of you know that it hasn't been the easiest year. We've survived. We've come through a very challenging environment, slow domestic and global economies. Markets around the world, as you all know, have been bouncing off at or close or above all-time highs, and yet volumes have been very low and are getting lower. So it's no surprise really that our results are steady and solid, but not great, although we are seeing great results from our indices. We've come through a period, or we're in a period now, of great global regulatory change, where a premium is placed on well-regulated exchanges and exchange-type services. And we're very proud of the fact here at the JSE that for 3 years in a row, we've been voted the best regulated stock exchange in the world. I think it's an accolade to the executive of the JSE, the staff, and of course to the leadership of the JSE, and I'm talking about the CEO. The JSE continues its collaboration with clients, with policymakers and regulators, and I think that that's good, because we have a good working relationship with our regulators, and there are parts of the world where the regulators and the actual exchanges never talk to each other. As I've said, we've seen lower volume environments for stock exchanges worldwide, coupled with increasing cost pressure from clients. Our clients are suffering. There's no doubt about it that the retail brokers particularly are suffering, and Nikki and her team are having a look at seeing how this can be eased. There are early signs of promise for our economy and for the exchange, and I'm talking about the National Development Plan. If we can get together and all of us put into practice what I think is a great plan, I think the economy can boom, and I think that we can return to growth, and I think growth's essential for this exchange, for the clients of this exchange, and more particularly for the country. We need growth, there's no doubt about it. Business has engaged with the government in the National Development Program, and will continue to engage with government for the next year or so. I won't go through those items there. You can all read. We are proud of our successes that we've achieved this past year. That first achievement, I think I'm correct in saying that we were the first exchange in the world. Leila, I'm looking at you. We were the first exchange in the world to achieve compliance, and I think it's been great for us. And I think the bottom item, the way forward on securities tax, has been a great relief to our clients. It's something that did worry the community a lot. Before I hand over to Nikki, because it's really merely my job here this evening to welcome you all and to say hello, I would like to say to you that it's an important night, I think, for Nikki. It's the first night that she's presenting results where she's been responsible for the whole year. She did make a presentation last year, but she was only responsible towards the tail end of last year's results. This is her first full year results, and I think she's done a pretty good job. So I'd like you to welcome Nikki and clap for me. Well done, Nikki. Be careful with this thing.
Thank you very much, Humphrey, and welcome everybody. I hope at the back you can hear well enough. Can you hear well enough? Okay, lots of hands. You can hear well enough. Excellent. Thank you very much. Those strategic achievements were part of the backdrop against which we were able to deliver, I think, really steady results as we've described. Revenue across the exchange group up 1.1%. For the exchange itself, as opposed to the group, it's the first time we hit the 1.4 billion rand revenue line, which is an important milestone for us. And for those of you who remember us 16 years ago, you will remember that we were sort of creeping around the sort of couples of tens of millions. So this is quite a considerable growth over the period of 16 years. Revenue up, earnings before tax and interest up 6.7%. The earnings after tax down between 12 and 15%, depending on whether you're looking at earnings or headline earnings, because of the tax implication of the unwinding of the impairment we had to make last year to our one big system. Our return on equity, 16.6%, which puts us in the early stages of our long-term incentive targets. Total operating expenses slightly down. That's important because this is a very fixed cost-based business and a variable revenue-based business, so we have to keep a really tight handle on costs, and I'll come back to that just now. And we're proud to have been able to declare a dividend of 250 cents, maintaining that dividend from last year. And I'll come back to that and our plans with regard to our investment in our business later on. Just turning briefly to look at the various divisions in the exchange. From an issuer regulation perspective, revenue is up 4.6%. Of relatively light listings activity. You can see that in the primary market, actual underlying listings down slightly. On the other hand, exchange-traded products, the likes of exchange-traded notes and ETFs up slightly, bond issues up considerably. We make money in the listing space from the initial listing and then from ongoing listing fees during the life of a listing. So that is a very pleasing performance. I'd have to say that in the first part of last year, we weren't at all sure that that was the type of number we could achieve. That's a light, as I described it, listing environment. That's in line with the globally light listing environment. It matters to this exchange whether we have a number of big, high-quality listings which contribute to transaction volume after that. And so we're very excited by the positive nature of the conversations we had with a number of issuers at the mining Indaba, by way of example. The other part of our listing story is we need to make sure that, as the only exchange in the country for the moment, that our listings regulatory environment is appropriate. Appropriate both for our main board and for our Altex companies. And that appropriate means the standard of the regulatory pitch has to be correct. So you'll recall that during the course of last year, we reduced the requirement on companies to publish extensive financial notices in the newspaper to more crisp notices intelligible to most of us. And certainly that reduces some of the compliance burden for companies. And we have an active process now re-looking at every line of our listings requirements to make sure that the pitch is correct. What we want to do is to make sure that the JSE is an active venue for capital raising for issuers that want to be there, and that we are not an unnecessary burden for those types of issuers. So we would expect to be able to make announcements in relation to our listings requirements during the sort of shorter term. From an equity market perspective, as you will know, the equity market is a large portion of this franchise's revenue. That speaks to our 125-year history, predominantly in equities, and in the last 12 years in derivatives, and slightly less than that in bonds. The equity trades are flat this year. Revenue is down 9.4% because we put a very aggressive price reduction strategy in place at the beginning of last year, in order to encourage more trade. So you might say, well, how on earth did that really work? But keeping transactions flat is in fact quite a substantial achievement in global terms. Our peer exchanges are close to double digits down in transaction volumes. So to maintain a flat volume environment is actually quite a significant achievement. But of course, when your revenue is down, your ability to continue to reduce fees is limited. That said, as the Chairman indicated in his opening comments, we are very well aware of the fact that our equity clients in particular, but this is true of our clients across our product range, are indeed feeling the heat. And we do need to look at how we price in the equities market, what I call here the total cost of conducting business in our market. And so many of you, because I can see a number of my broking clients here, many of you will be talking to our equities team about how we price going forward and what structure we can adopt. What we need to do for the exchange and what we need to do for the business is to make sure that we price so that more activity happens on our market. Okay, so that is pricing is an art, not a science, but that's where we're going, is to try and make sure that we relook at the pricing to encourage more activity. Of course, during the course of the year, not unnoticed for those of you who are actively involved in the equities market, we replaced our equity trading engine, bringing back from London the trading engine, implementing the Millennium IT trading engine, on time, on budget, minimal market disruption, 400 times faster. That too has contributed, we think, to increased activity on our market. And it creates the beginning platform for us to be able to look at the next generation derivative trading engine which we are looking at. You will also be aware that this time last year we were making the point that we would need to relook at our equity market business model. This is the manner in which we actually operate the equities market. Separately capitalized subsidiaries in South Africa, no foreign members, guaranteeing equity trades off our balance sheet. We are relooking at that. We have done an enormous amount of work internationally. But we're not going to move dramatically fast in any manner off our current model. It is an extensive piece of work. I'm very appreciative to the many faces here that I know worked with us on that project. We will continue and complete the work on that, make a decision as to where we want to go. But even were we to have made a decision today on that, and we haven't yet, but were we to have, it would still be years before we would move there. Okay, so I suppose my message in that regard is it is so that the JSE operates its equity market in a different manner to the global equity markets, or how they are operated. But there's not necessarily anything fatally defective in the manner in which we currently operate our market, and we need to decide how we want to evolve. And we'll take our time making those decisions, and we'll take our time having made decisions evolving. In post-trade services, revenue is up just over 1%. This is linked to the risk management of the equity trades, so it follows very much how the equity trading patterns have worked. We have achieved in this division, outside the equity space, as Humphrey said, the very first global CPSS IOSCO compliance. That's for our derivatives clearinghouse. And that's creating opportunities for us going forward from a risk management perspective. One of the opportunities, we think, to move this business away from transactional reliance to more reliance on more valuable parts of our value chain further down. We've also integrated the post-trade services business, which means for those of you that work with us, when you talk about risk management, anything after trade, you're talking to one team. And we're busy building the strength of that team. This year, the focus in this area is in over-the-counter clearing. Can we build a business case that will work for both ourselves and the participants in the industry to provide a local over-the-counter clearing business in South Africa? Obviously, we would like to put up our hands to run that independently of the participants, but there is a lot of work to do to establish that particular business case. And then, of course, we do need to strengthen our on-exchange clearing business. Having got the IOSCO compliance, the point now is to raise the level at which we're doing things, because standards only go up in financial markets. Looking at our back office services, the BDA that the equity members, I'm not sure I was going to say love, but perhaps love to challenge. But nonetheless, the back office services BDA compulsory to be used by our equity members, 4.1% up in revenue. It does give us unparalleled surveillance and risk management capability because of the insight to client level information. But as we've indicated in the results, we are quite clear of the fact that we will be on BDA till at least December 2015, and probably further than that. Having made that decision, it is now open for us to look at how do we move to T+3 using BDA as that platform. And the team is working very hard on that, and I'll come to that just now. But I suppose for the brokers in the audience, the important point here is that we're not moving off BDA soon. From a bonds and financial derivatives perspective, we're excited by the fact that this particular team has managed to increase the interest rate revenue substantially, particularly in the latter half of the year. Changing the pricing mix in the interest rate and the currency markets has definitely increased market participation. It's a point we make to our shareholders all the time, is that our general philosophy as management is to reduce the pricing so as to increase activity, and that's exactly what you see in this market. This team also upgraded the trading technology during the course of the year, but we are looking at a next-gen trading engine for equity derivatives. We are looking at whether MIT, the engine that we use in the equities market, would be capable of being the engine for the equity derivatives market, and subject to the commercials and it being functionally fit for purpose, that's where we intend to go. We're also very excited that Treasury has finally indicated that it wants to move trading for government bonds onto an exchange-traded platform. This is something that Mr. Lawless will smile about, since we've been talking about it for years and years and years. But finally, Treasury has put the stake in the ground and now is building those requirements, detailed requirements for the in the three-letter acronyms familiar in this industry, the ETP for government bonds, which is the future we're going to. From the JSE's perspective, we would obviously like to be in the mix in providing that platform for Treasury. We believe that we can do that extremely cost effectively, specifically leveraging our already our already existing spend in governance structures and licenses and the like. Whether or not we will partner with other technology providers to deliver this for government will depend on what the requirements finally are. But we're excited. We certainly feel we are further down the line now than we have been for many, many years in relation to the ETP for government bonds. In the commodity derivatives space, our team has managed to grow that business again. 5%, very good increase in the number of contracts. Very interesting new products coming online. So particularly interesting alliances, affiliations with the likes of the CME, with the Zambian, with some of the players in Zambia, and we're looking forward to that growing next year or this coming year as well. And then the market data team has managed to grow revenue by 17%, up from almost nothing 16 years ago. And I suppose this completes the story of the diversified nature of the JSE's revenue. We have worked incredibly hard to make sure that we get revenue from a number of different places in the value chain so that we can continue to reduce our reliance on transactional revenue. If you don't charge little bits throughout the value chain where we're contributing on the value chain, you end up having to charge everything on transaction revenue. That then only focuses all your costs, all your pricing on certain types of clients. So it is a clear strategy of ours to diversify our revenue. The 17% up, for those of you worrying, does not come from a 17% price increase. It comes from increasing the number of terminals we have, particularly terminals internationally. That's good for us, because if we can get more terminals internationally, people are buying JSE data so that they can see what's happening on this market. Eventually that translates into transactional revenue, which is what we want. And the other side of the foreign terminals is it's a natural hedge to our foreign liabilities, which are not huge but exist nonetheless. So terminals up, that will continue to be the focus for us in the data side. We are also putting a lot of effort on automating client interaction with us. Those of you who have to fill out our endless returns and things will know that it is a reasonably painful experience at the moment. We intend to take the hassle out of compliance, and so we are putting a huge amount of work in the automation. Then, of course, investing in growing the type of data we are able to provide clients becomes the next focus, and that will be focused later on this year, next year. So all of that translates to areas of growth except in equity transactions across our value chain in a very diverse way. This pie is beginning to become more and more diverse every year, and we intend to continue to push that type of diversity as a management team. That translates to financial highlights. The revenue steady despite the challenging environments, despite particularly a disappointing equity trade performance, but made up because of the diversity in the interest rate and the market data performances. Operating expenses are slightly down, only slightly down, and you might wonder how come that is if you can have personnel expenses up 18%. The reality on personnel expenses is IFRS requires you to account for how you actually spend your money in a different way. But if you were to actually look at what we paid staff and forget the accounting, it was only 1% difference. So headcount is down just nearly 10 people, but the staff costs about 1% up last year on 2011. This year, staff costs, we gave increases and adjustments, promotions, etc., under 6% in total. So we're trying to keep a very tight handle on costs. Other expenses, if you include the impairment costs, 8%, just over 8% down. If you exclude the impairment costs, other expenses went up. Some of those costs, other expenses went up, is because of how we account for staff who used to be capitalized when they were consulting, and when we stopped capitalizing them, we then expensed them, so they went up in the labor broker type staff who went up in the consulting lines. Other because we deliberately went and sourced consultants to help us, so we didn't have doing certain international research, so that we didn't have to put in full headcount. So overall, though, expenses extremely tightly controlled. As I said at the beginning, a fixed cost base, variable revenue, best you control your expenses. That's our strategy. That's how we intend to stay. Translates to EBIT up. The EBIT margin, 1% up to 29% from 28% last year. The NPAT down 12%, but that's because of the way that we've had to treat the write back of the deferred tax asset. All told, from a financial perspective, we think that's a solid basis to look to the future. So I'll just deal briefly with where we're going, and then we can see who's got some questions. That solid basis allows us a dividend of 250 cents a share. That's a quite significant improvement in the dividend cover, which is 1.56, better, an improvement from 2.19%. It's within our range. We're not planning to change the range. We are not planning a special dividend. For the analysts that are about to pepper me with that question, we think this is quite an aggressive dividend. And then leaves us in a position to fund our expenses and our investment in our business going forward, we think, keenly. Then looking at that investment going forward, we have, from a management and board perspective, a 45 million projected spend on business as usual. This is the spend you have to do consistently in upgrading our IT environment, networks and the likes, the sort of business as usual project spend. That's not unusual to any of you analysts who watch us. Then we have indicated a 200 million rand projected third-party spend. I need to emphasize the third-party spend. This is potential spend we would contract with third-party suppliers. It's not staff who might work on projects that in due course we would capitalize. That spend, we have in mind a portfolio of investments that speak to us being able to deliver our strategy. Okay, and that strategy is about those things that will grow this business and those things that will sustain this business. And I'll come to that just now. 200 million, and we haven't committed all of those. Some of that we have started. They will have different timelines, and we are busy at the moment working through which ones to push the start button on first. I do want to indicate for those of you who are students of our balance sheet that at the end of just post balance sheet event, at the beginning of this year, we made 100 million rand contribution to the new default fund for derivatives. This we had to do in order to ensure that SAFCOM was CPS IOSCO compliant. It is JSE money. It is in the default fund. It is ring-fenced. We get the interest on that. But if we want to maintain a clearinghouse, we will be required to maintain the 100 million in that default fund. It will only ever be attached in very limited circumstances, subject to the default rules and so on. But it is there as an investment in our clearing business. So then looking at our investments that we think are necessary to build this business to survive the test of time. Investing to grow. We are looking at making investments in the over-the-counter clearing space. In order for our banking clients to achieve maximum relief under Basel III, which, as you know, is a regulatory requirement, they will need, in due course, to clear over-the-counter products through an independent clearinghouse. There is some discussion in this country as to whether that clearinghouse should be local or foreign. We certainly feel it should be local, and we are doing the homework at the moment to figure out what it would take for us to be able to offer that. We certainly recognize that if we were to offer this, it has to be cost effective. It has to be something that has the clients wanting to work with us. I think there's a partnership model available there, but we have done an enormous amount of work and are at the tail end of deciding whether or not we can in fact do this. If we were to do this, the timing is somewhere during the course of the early part of next year. The size of this, if we decide to do it, we will be clear with our clients and our stakeholders with that in due course. So that's part of what is earmarked as potential investment from our 200 million. Then we've got the market data improvements. We are working very hard in the market data space to continue to automate our client interaction. We are already working on that, and there is also a work going on in upgrading our regulatory software in the listing space. So part and parcel of enabling us to grow those business areas and service our clients better, that's part and parcel of what we have already commissioned out of our 200 million clearing, potentially still to come subject to business case, market data and listings already on the go. Co-location, for those of you that are broking clients, this is our looking at whether or not we can host client computer servers very close to our trading engine. We have spent an enormous amount of time working on this with clients. It is a very interesting business opportunity for clients who can reduce the latency between, that's the speed between themselves and us. It's an interesting opportunity for us, although client appetite for something like that seems to be weaker than it was 18 months ago. I think that's a reflection of the fact that times are stressed, as the chairman started out by indicating. So we're busy building that. We're busy assessing the client final demand for that. We understand what it will take to deliver co-location, and we will deliver it if there is sufficient client demand. Then there is investment that we need to make in order to strengthen our existing business. The derivatives, the equity derivatives trading engine, as I indicated, if we want that business to grow, we need a next-gen trading engine. We need to do that, we think, using as far as possible the investment we've already made in the equities market. So the team is working very hard on that, and we have not yet commissioned that. We are finalizing the business requirements. If we're comfortable with it and we're comfortable with the price, then we will push the button on that. That also will have to come out of the 200. And then we are going to move to T+3. The exact timing for moving to T+3 is a matter of discussion. Between us, the regulator, you clients will also be involved, because there is a lot of client activity and change that will be required. And then, of course, Straight itself has some changes it will need to make in order to accommodate T+3, but it also has its own priorities. So we are balancing all of these things before deciding which order to do what. All right? But I suppose the takeaway on all of those things is we are going to need to do many of these, probably all of them, depending on us being comfortable that it is appropriate for us to implement them. Now the question will be the order in which we do that. Because what we can't do is try and do everything. We've got to do the right things in the right order, get them done, and then move to the next thing. That certainly is the message I'm hearing from the clients that I have had the pleasure of seeing so far. basically saying we're all in favour of evolution, but we've got a limited appetite to move too fast, too far. And so, you know, we are really listening at that. From a business perspective, we need to deal this issue of the cost of transacting on our markets. Coming back to the point I made earlier about the fact that if as a sole provider, if you don't actually have your pricing points absolutely keenly pitched, clients start to look at alternative ways of structuring their business. And we certainly want a business that has clients doing more with us rather than less with us. And so we're not deaf to those comments. We are looking specifically in the equities market at making short-term adjustments to the way we to the way we price in order to give immediate relief to clients, and looking at a more structurally different type of pricing towards the middle of or Q3 of this year. For the shareholders listening to that particular line, obviously we have to do that in a manner that ensures that as the market grows, the JSE participates with its clients in the growth in that market. So there is a win-win model we have to find in how we restructure our pricing. And I think that's true of anybody providing services to clients. I've talked about us needing to finalize the equity market business model, finalize it so that we know where we're going, not necessarily move there. All right? So it is important because all of us involved in that project are spending a lot of time on that. That's time, that's investment, that's cost. We need to get that to an end and then decide where we go from that. And then it is important to all of you that you know from a technology perspective what we have in mind. We have worked very, very hard on our technology roadmap so that we can provide clarity to our clients about we're going to do this with trading, then we're moving here with clearing, then we're doing that with trading, the whole roadmap. As soon as we have completed the discussion on clearing, then we will be able to publish that roadmap, which is what we'd like to do. So I think with that as a background, I'll stop and let everybody sort of pile in with some questions if you want, and before wrapping up. Who'd like to start the bidding on the questions? Stan, Mr. Lawless. Bringing you on.
Nikki, thank you very much. Two questions. One is around the lingering SAFEX debt that, on your balance sheet of about 1.2, 1.3 million. Why is that still there? Why has that not been resolved? Second question is completely different, is around Straight. What is your take on the rumblings in the market around Straight being overpriced, over-regulates the market, and also allied to that is what revenue do you get from Straight in these financial statements? Okay,
so the SAFEX item is when we bought SAFEX, we retained certain money pending the resolution of certain outstanding legal issues from memory, outstanding legal issues, and then that money needed to be returned to shareholders, not all of whom could be found. So that's sitting there pending sort of SAFEX shareholders missing in action. Essentially, as far as I recall. The question on Straight, you know, regulation. Everybody likes to take a pot shot at regulators until it goes pear-shaped. Regulation is priceless when things are in stress, and so you know, certainly those of us that have had to live through a number of close shaves would suggest that a very close eye on regulatory on activities by regulators is worth its weight in gold. But even as a regulator ourselves, we have to balance this all the time. So from a Straight perspective, and I think they face the same issues that we do. When you're a sole provider, there are always rumblings. Nobody's ever sure that you have priced at the keenest possible price you can. I think in certain of the, and I'm not sure particularly which rumblings you might be talking about, but if you're talking in relation to the issuers, then in certain spaces, I think there is space for more holistic communication in relation to why price points are chosen. We've discovered that ourselves, is that you know, the more transparent you are, the more clients understand why you were looking at pricing in a particular way. But sitting on the Straight board as I do, you know, Straight has a has a perspective that it is not trying to build up huge resources. It's trying to build up sufficient resources so that it is self-sufficient and able to continue to reinvest in its business without coming to clients with a line item that says charge for reinvestment. It needs to be to build up in that regard. So to the extent that the issue is about communication, I think we can all learn. I think we can all learn in that regard. We equity account straight, so we account. I don't know how much is it this year, about 35, I want to say, million in this year from straight. Comments, yeah.
Ask 3 JSE 101 questions.
Sure.
They might be very basic, so bear with me. As investors, how do we think from a medium-term perspective about the risk of trade going off-market? I'm thinking about institutions, for example, dealing through pools, etc. Or if exchange control goes, that it may be preferable for particular institutions to trade through an overseas market. Question 1.
Yeah, so clearly as an exchange, it's in our interest to make sure there's as much activity on this market as possible. Now, exchange control is a double-edged sword. It prevents people feeling as comfortable, foreigners feeling as comfortable as possible to come to South Africa, but it does to some extent limit how South Africans are able to trade on offshore markets. That doesn't mean that they can't trade off the exchange. They can trade off the exchange. All of our products have vibrant, competitive OTC products. Not exactly the same, but competitive. Our role, the way we look at it from a management perspective is we've got to run this exchange on the assumption that there was a competitor right next door. So we make it as, we try to put the products on the shelf, make the services we offer as slick as possible, as competitive as possible, and make the pricing as attractive as possible, so that you essentially proactively make it as difficult as possible for a competitor to actually succeed. In extremis, were we to lose a significant portion of trade, that would be bad for South Africa, because what you want is a vibrant local market of depth. You want people to know that the best price that you can buy Old Mutual, as an example, is on the JSE. You should never have to worry about, do I have to go there and there and there? Because by the time you've gone to the third venue and come back to the first venue, the price has moved. And they found that in international markets when they have allowed fragmentation, that actually clients end up spending a lot of money connecting to multiple venues. So ultimately, we are trying to make this place as efficient as possible so that it is as difficult as possible for a competitor to find an attractive audience with any of our clients.
Thank you. Question 2. The BDA, you're going to retain until 2015. How do we think about the risk of that revenue deteriorating post-2015?
It's possible we'll be on BDA for much longer than 2015. We just wanted to put a line in the sand so people could stop worrying about modeling scenarios that I can't even talk sensibly to because we haven't thought about them yet. So BDA will be there as a substantial part of our business, but BDA is part of the total cost of doing business in the equities market, and we do need to look at it holistically and say, is it part and parcel of what is causing the stress point from a pricing perspective for the clients? So we are going to look at that, but we're not going to look at that in a manner that says we can't charge for BDA anymore. Okay, so we certainly don't want to erode that revenue, but we do have to think about the fact that if we're going to grow this market, pricing has to, as far as possible, be more predictable to clients, more balance what clients get to what the JSE gets, and so that's what we're working on.
Last question, if I may, bear with me.
No problem.
Your one slide spoke about other expenses declining by 8.8%, which you say reflects efforts to keep the cost base under control.
Yeah.
As I would understand it, I'm just going to make sure I'm comparing like with like, but the other expenses have gone from 738 to 672 million. If I strip out the intangible impairments, if I'm comparing like to like, I'm comparing 510 to about 600 million, which actually talks to growth of about 18-odd%.
Yeah.
I'm talking rough numbers.
Yeah, that's roundabout.
So that's actually quite high cost growth.
As I tried to indicate when I was chatting, when I was sort of presenting that slide, is if you strip out impairments, yes, costs have gone up. Those costs have gone up for a number of reasons. They've gone up in the consulting space, and when you get the detailed analysis, you'll see that. They've gone up in the consulting space and for two specific reasons. The big increase is in consulting for two specific reasons. Half of that is because of the different treatment of what we call labour brokers, used to be capitalised, now being expensed. So it's not really a different spend, it's just in a different place in our financial statements. And then the other half of that are almost once-off spends on advice in relation to the evolution of things like clearing and the equity market model. So we don't expect that type of cost to recur. The other big chunk of increase is in relation to IT increases. And if you look at all of the line items, there are one or two which are once off, but there are sort of general IT increases.
In terms of going forward, how do we think about the sustainability of that cost? Is that likely to, that number of about 500 odd million, 510, is that from a modelling perspective, is that kind of a hardcore number, a base that we should expect growth from, or is there one off in there?
I can't give you guidance on that, because if I gave you guidance on that, I'd need to probably shoot you. So I need to be very careful, very careful about what I want to do. I think the best way for me to say it is we're keeping a very, very keen handle on costs. So we have to get to a situation where the once-offs are out of the way, so that the sort of once-off outside advisors to look at international models, and then the non-capitalization of resources. Once we get that out of the way, then you'll have a more balanced perspective. So I think we're probably a year away from being very clear on that, except we are keeping a very, very tight handle on what those costs do.
Thanks, Nikki.
Sure, no problem. Michelle, were you wanting to?
And Nikki, I have a question that we received via our webcast. Could you provide more clarity on what you mean by short-term pricing adjustments you'd be looking to make? And what sort of longer-term pricing adjustments are you referring to beyond the third quarter of this year?
Okay, so thank you for that comment. So the short-term pricing adjustments I'm referring to are in the equities market, where there is a particular burning platform for clients, where we are trying to ensure that what has happened this year, for those of you who are students of the market, transactions are 45% up year on year. But the value traded is only 3% up. We bill our clients on transactions. They receive revenue from their clients on value. So you can see that our bill to our clients is bigger than their check from their clients, and this is not sustainable. So we are going to so we are looking at how do we sort of readjust that or give something back in a sustainable manner in the very, very short term for equity clients. The longer term one, I wish I could be more clear. We are consulting with clients on a number of different models. Whatever those models end up with, it has to share the upside. It has to make sure the JSE has upside in the growth, because it costs us to continue to build an environment which is capable of handling bigger transactions. But it also has to give back to the equity clients, because what we want to do is to make sure that more clients, more transactions come here. We do not want clients to be saying the pricing is so difficult here that we have to go and find other ways of doing business. That's not a sustainable model for us. So I can't be clearer than that, because we're still consulting on it. Was there another question, Michelle?
That's correct. There's another question via the webcast. That is, has the JSE given any thought to establishing a transparent market for the trading of electricity?
Well, over the years, yes. Over the years we have. It's not that easy. But we're not actively working on that at the moment. There are a number of exchanges globally that have electricity markets, but we haven't actively, we're not actively working on that at the moment. Any other questions? Michelle, nothing else? Okay, well, so not wanting to stand between you and refreshments, I would just like to thank you very much for gracing us this evening. Just to say to you that it has been an absolute privilege to lead this wonderful organization and my fabulous team for the year, and I'm looking forward to being able to grow this business this year. Thank you very much, everyone.
This is